S corporations, the last section. You guys aren't up celebrating. The last section of the book that we're going to cover. I guess that means you all love tax. That's good. Okay. So what we've been talking about are C corporations. There is another type of corporation I've talked about a little bit, called an S corporation. And an S corporation, I think I described it this way on Tuesday. If a partnership and a C corporation got married and had a baby, it would be an S corporation. Because it's a hybrid between the two. It has some of the features of a corporation. I mean, it is a corporation. It's in the name. But it also has a lot of the features of a partnership. So it is, and the features that it shares with partnership, the big one is it's a pass-through entity. So remember, with partnerships, all the income and expenses pass through to the owners at the owner's own tax rates and everything. So it retains its character and flows through. And remember, we had ordinary income and we had separately stated items. Got the same thing with S corporations. So it works the same way. Also, remember with partnerships, we had to keep track of basis as we go. Had to constantly keep track of that, the increases and decreases. With the C corporations, we really didn't have to do that. You know, the basis doesn't really change unless you buy more stock or sell some of your stock. With S corporations, we've got to keep track of basis again on a continuous basis. So it's continual. So like a partnership in that respect as well. Now, one of the ways that it's like a corporation is that the owners of an S corp are allowed to be employees. Remember, with partnerships, partners are not employees of partnerships. They are partners. And so they don't get a W-2. They get those guaranteed payments, and then it's subject to self-employment tax. Well, with S corporations, owners can be employees of that corporation. They can receive a W-2, and they don't have to pay self-employment tax on that S corp income. That's one of the big attractions of the S corp formation, is that owners don't have to pay any self-employment tax on income from the S corporation. Now, they still have to pay FICA tax, Social Security and Medicare tax as an employee, but it's treated like an employee. The corporation's paying half of it, and the employee is paying half of it. Now, there are lots of limits to that I'm not going to go into the specifics, but I just wanted to illustrate one of the ways in which it is like a corporation. So owners can be employees of an S corporation. Another way, I just had it, there's another way that it's like a C corporation. Oh, stock. So S corporations have stock. They're corporations. Just like C corporations have stock. Partnerships don't have stock. Partnerships have ownership percentages. But the S corporations have stock. So stock that can be bought and sold. However, there are limitations on who can be a shareholder in an S corporation. For a C corporation, pretty much anybody can be a shareholder. And any other entity can be a shareholder as well. It could be a partnership that's a shareholder, an individual that's a shareholder, an S corp that's a shareholder, another corporation that's a shareholder. There really aren't any limitations on who can be a shareholder in a C corporation. In an S corporation, there are limitations on who can be a shareholder. So first off, it has to be a domestic corporation. It cannot be a foreign company. So it has to be based in the U.S. Has to have 100 or fewer shareholders, all of which have to be either individuals, estates, or certain types of trusts. So you notice partnership cannot own C corp cannot own an S corp. So the shareholders have to be only one of these three types of entities. And you can only have up to 100 of those shareholders. Now, a married couple, each person counts as one. Well, I shouldn't say that. The married couple together counts as one person. So if each spouse is a shareholder, that only counts as one toward that 100. So technically speaking, you could have up to 200 if they were all married and each of the spouses owned shares. But it is limited to 100 or fewer shareholders. It can only have one class of stock. C corporations can have multiple classes of stock. Different classes of stock give different privileges to shareholders. Certain classes of stock, they take precedence with regard to dividends, or take precedence with regard to liquidation, that sort of thing. With S corp, everybody's equal, only one class of stock. Also, shareholders have to be U.S. citizens or resident aliens. So foreign individuals cannot own shares in an S corporation. Okay, so that's a lot of restrictions there as to who can own an S corporation. The S corporation, in order to elect to become an S corp, now remember I went through at the beginning of Tuesday's class, I showed you the Secretary of State's website and went through all of that. S corporations are not recognized as a separate type of corporation under state law. They are solely a tax entity. They are a corporation that is choosing to be taxed as an S corporation. So there's nothing special that really has to be done with regard to Secretary of State or from a legal basis, but from a tax basis, you do have to choose to be taxed as an S corporation. So you have to make an affirmative election, and you are time limited as to when you can make that election. Like I said, the big benefit of an S corporation is that the income is not subject to FICA taxes. It's not subject to Social Security or Medicare taxes, like with a partnership where that ordinary income and the guaranteed payments would be subject to self-employment tax. That is not the case with an S corporation. That said, S corporations they're a very popular form of corporation. They're a very popular form of business. In my experience, I mean, most of the tax returns that I prepared were individuals, but second were S corporations. They're very, I don't know, do you have?
S corp?
Yeah.
Just a few.
Just a few? Okay.
11, just C corps.
Oh, you have mostly C corps? Are they C corp? I'm curious. Are they C corps that have been formed in the last few years?
Yeah, I don't.
Okay. So the S corp has that tax advantage with regard to FICA taxes. But when they changed the tax law to lower the tax rate for C corporations, the C corporations then became more popular to form because there were greater tax. So now, like I said, S corps are pass-through entities, which means that the income from those entities is taxed at the individual's tax rate. If they're in the 37% tax bracket, the highest tax bracket, and they have income coming in from an S corp, that income is going to be taxed at 37%. If, however, instead of being an S corp, they're a C corp, well, first off, they don't have any income flowing through to their individual tax return, but that C corp pays a 21% tax rate now. So oftentimes, and especially for those higher income individuals who would not be hit by that increased, they would not be hit by the self-employment tax as much because they're already exceeding the wage base for Social Security. The tax advantages of the S corporation go away, but the tax advantages of the C corporation increase now with that lowered tax rate. Back when the the highest tax rate for C corps was 35%. You didn't have those advantages. But now, probably seeing a lot fewer businesses form S corporations. S corporations, like I said, when I was preparing taxes, they were the most popular business formation, at least for tax purposes. Had a lot of S corporations. They're small businesses for the most part. I mean, if you've only got 100 or fewer shareholders, it's probably naturally going to be a smaller business. A lot of mom and pop type of operations would choose to be taxed as S corporations. Now, there are a lot of very strict rules with regard to like I said, if you are an owner, employee of an S corporation, there are some very strict rules with regard to that that we're not going to go through here. But you can be an employee of an S corporation. Let's see, what else do I want to say about S corporations? So I already mentioned taxable income and separately stated items. We've got that on S corporations, just like we had with partnerships. This is, you'll notice, so we've got the income items here, looks a lot different from the 1120, because on that 1120, we've got interest, rents, royalties, capital gains, all that stuff included in the income, because it doesn't get any special treatment. But on the 1120S, those items are not here because they're listed under separately stated items on the Schedule K. So it has, the S corp return also has a Schedule K right there for all those separately stated items. There's a balance sheet on it, just like the C corp, just like the partnership. There's an M1, just like the C corp, just like the partnership. You gotta have that reconciliation. And there is a K1, just like a partnership. This is what owners receive from S corporations. Looks a lot like a partnership, K1. A lot of the same types of items. We've got our ordinary business income and then all of our separately stated items of income and deduction listed there as well. Ownership percentage over here, and it works the same as with a partnership. So the ownership, that income is going to flow through to each shareholder based upon their ownership percentage. Okay, so if it's a 50-50 S corp, then 50% of that income is going to go to each of the shareholders. Here's an example of that. I probably don't need to. So we've got Tamara and Zeke, they own a S corp together. $48,000 of ordinary income, $3,000 of dividends, $1,000 of charitable contributions. So it would be, if they own it in 60 to 40% ratio, 48 times 60%, Tamara's gonna have 28,008, Zeke's gonna have 19,002 of ordinary income. The other income and expense items are going to be divided similarly, based upon their ownership percentage. Basis. S corps have that basis issue as well, just like partnerships. The items that increase basis are very similar to the items that increase basis for a partnership. Income increases basis. Separately stated income items increase basis. Any additional contributions of capital, be it cash or other property, increase basis. Loans from shareholders, so the shareholder is allowed to lend money. Maybe you don't want to do a capital contribution, you just want to loan the S corp some money because you want to get it back eventually. Loans also increase basis. Decreases are generated by net losses. They're generated by separately stated expense items, and they're generated by distributions from the corporation based on fair market value. Okay. One thing that's a little bit different, when we had the partnerships and a partner received a distribution from the partnership in excess of the partner's basis, then the partner had to report a capital gain in the amount of that excess, right? It reduced the basis down to 0, and then any excess over and above that was capital gain to the partner. Well, if a distribution is made from an S corporation and there isn't enough basis, then those, it's called a suspended loss. Like losses, any losses that are generated have to be suspended. You can't take it currently. You have to wait until you've got basis to cover that loss. So a little bit different from a partnership in that regard. Let's see. What else do I want to say? Any questions?